Welcome to MarketTamer.com. Yesterday we were speaking about the fact that the markets were very overextended, the fact that they had come outside the Bollinger Bands in many cases and a pullback was due. So at that time we spoke about the fact that an intraday trading opportunity existed for the bears to buy some long puts, take advantage of a quick drop. That's exactly what we've seen this morning. We've seen the pullback down to the 5-day moving average. And at this stage, this would be a time to actually take profits on that position, since we've just about hit the 5-day and we're bouncing off it slightly intraday. As we look to the future, it may well be the case that the market continues below that level, but the key thing when trading is always to define what our exits are. And in this case, the exit was simply to take profits upon a pullback to that short-term moving average. That's occurred. No reason to abandon discipline at this point. So it's time to jump out and move on to the next trade. We've seen yesterday that the Dow was the laggard. We see that again today. Here, what's pretty important now is that the 200-day moving average has held on the Dow, but so is the 5-day held to the upside. So we're in a period of decision making here for the Dow. Current trend is up, so the probability favors a break above that 200-day, given that the other moving averages have broken above it also. And if we look to the NASDAQ, what's really interesting again about the NASDAQ is that it yet again is outperforming. So it's outperforming on the upside, it's outperforming on the downside. And what I mean by that is on the up days, the NASDAQ is moving higher in percentage terms than the S&P 500 or the Dow. And again, on the downside, it's also moving down to a lesser degree. Here, it's moving down by only 0.56%, which is less than both the S&P 500 and the Dow on an intraday basis, yet again confirming its leadership position of the indexes. Now let's move on to the US dollar index. Here we can see that the US dollar has absolutely fallen off a cliff. We're dropping, obviously we dropped below the key 80 level recently. We've continued down and we're even approaching the December lows here, right around the 78, 79 area. What's interesting about today's chart is that not only is the US dollar dropping, not only has it dropped in the past, but it's also dropping today, even in spite of some market weakness. So on the whole, we would be very, very concerned about the market if this US dollar trend changes, because if we look to a comparison of the US dollar versus the S&P 500, just notice, for example, from the start of the year, the S&P 500 dropped pretty substantially all the way through to March. If we return to the US dollar index, what did it do? Well, the dollar actually rose all the way through to this March period. And then from March all the way through to June here, we've seen that the dollar has dropped. What has the market done? Well, we know from March through to June, the market has risen. So we're seeing very close correlation there. That tells us that much of this rally is driven by dollar weakness, not necessarily by underlying organic or fundamental strength. Again, that leads us to be concerned, and so we are still skeptical of the long-term strength of this rally. And we've seen in the past in some of our member discussions that there are retracement levels just above where we're at in the market right now, 38% retracements from the low, and we do expect that they will hold. We do not, in short, expect that the market will have much more to go to the upside once it reaches those retracement levels. In fact, we think there's a very, very good chance of a correction at that point. So with that said, we will leave it there for now. And please do not hesitate to come into any of the classes, ask questions, jump into the forums, and we'll be delighted to answer your questions. Look forward to seeing you then. Bye-bye.